Please come to IFRS 2. What is IFRS 2? Accounting for share-based payment. A very interesting accounting standard. This standard gets reference in other standards also. Like for example, in IAS 16, cost of an asset, if acquired using share-based payment, will be accounted as per IFRS 2. Then in IAS 38 also, if an intangible asset is acquired by share-based payment, then the cost will be calculated as per IFRS 2. Even in IFRS 3, you will find a reference of IFRS 2. So this standard will be having impact on other standard also. What is this standard about? If an entity makes payment either for goods or services, either to suppliers or employees, then the payment made, if either in the form of share or if it is related to the price of the share, then such transactions will be accounted as per IFRS 2. And then there are many accounting issues which will get involved. For example, how to do the recognition, how to do the measurement. In case if the issue of share is dependent on some conditions, that is called vesting condition, then the issue will be how to apportion the expense over the vesting period. Okay. So all these issues we will discuss line by line in this wonderful IFRS 2. So many companies, in order to motivate their employees, they give them some remuneration which may either be in the form of share or may be related to the price of the share. So therefore such schemes, such arrangements are called share-based payment, where the payment will be based on the price or the value of the shares. Example, what is popularly called ESOP. What is the popular term for this? ESOP. But this standard not only covers ESOP, it covers all forms of share payment, not only to the employees, but also to others. Like for example, if you buy a machinery and issue share as a consideration, even that will be covered by this standard. So share plans and share option plans are a common feature of employee remuneration for directors, senior executives, and many other employees. Some entity issues shares or share options to pay suppliers, such as suppliers of professional services also. Like in one question that will come later, company received consultancy service, and what it paid? Shares. It settled in the form of shares. So you have to do the accounting of that also. You can use share for payment to supplier of goods and machinery. You can use shares to make payment to your employees. So such arrangements are called share-based payment arrangement. Is it right? Now the question number 1, what is share-based payment arrangement? It is an arrangement between the entity, but as you move ahead, the standard becomes complicated, or another group entity or shareholder of any group entity and another party, including an employee, that entitles the other party. So it's a share-based arrangement between the entity, you directly, or another group entity, means either subsidiary or parent, or any shareholder of group entity. Like one parent may have two subsidiaries. One subsidiary may be holding share in another subsidiary also. So he is a shareholder of another group entity. Sometimes what they do, in order to motivate their employees, they not only commit that we will give you share, they also may commit we will give you share of another group entity. Right? Why will an employee accept the share of another group entity? this entity may be an unlisted company, small entity, whereas the other member of the group entity would be a listed company. Then internally they will do the transaction among themselves, but this also will form part of share-based payment arrangement, where a subsidiary pays the employees in the form of parent share. Parent company pays in the form of subsidiary share. Those will also be covered by the standard. That entitles the other party. 99% question would be direct. Entity and other party. But in the last segment we will discuss when one group entity uses the shares of other company for this kind of arrangement, right? But 99% question will be you will issue share based payment directly to other party. Now what are the modes of payment, cash or other asset? Student have asked me this question. If it is cash or other payment, then why it is covered under this standard? The reason is that they are based on the price or value of equity instrument of the entity or another group entity. Even though you are going to pay cash, but the cash to be paid is linked to share price. For example, there is a scheme called stock appreciation right, SAR. In SAR, what happens? There is an agreement with the employee. If the share price on exercise date, is more than 30 rupees, then we will pay you difference between market price and 30 rupees. So here payment will be cash, but the cash to be paid is linked to market price of the share of the entity or group entity. But the most common ones are this one, equity instrument, including share or share options of the entity or another group entity, provided the specified vesting conditions, if any, are met. So what is a share-based payment arrangement? It is a arrangement where an entity pays in the form of share or cash, but the amount of cash paid is linked to share price. Next is what is share-based payment transaction. It is a transaction in which the entity receives goods or services from the supplier of those goods or services, including an employee, in a share-based payment transaction, or incurs an obligation to settle the transaction with the supplier in a share-based payment arrangement when another group entity receives those goods or services. So again and again they will repeat this line, group entity. Okay, share-based payment transaction would be one where you receive the goods or services, or you incurs an obligation to settle the transaction with the supplier in a share-based payment arrangement when another group entity receives the goods or services. Now let us look at this definition of share-based payment transaction. It says share-based payment should be formed when there is an agreement between an entity and a party. Most of this discussion would be centered around employee, but please remember the standard is applicable to others also, suppliers of goods and services also. First point is share-based payment will come into existence when there is an agreement. An intention is not an agreement. Employer and employee must agree to the terms and condition. Employees should be communicated about the terms and condition. Then only a share-based payment plan will come into existence, which means that communication of terms and conditions should be in place in order to have share-based payment. Now, question. Solve this question. A management committee of an entity has initiated a plan to provide some stock option to its employees, but there are some terms which are yet to be finalized and the plan is not yet communicated to the employee. Is it a share-based payment transaction? Can we account it as a share-based payment transaction? Say yes or no. The answer is yes, no. The answer is no. Because the agreement is not yet finalized. Some terms and conditions are not yet finalized. Plan is not yet communicated to the employee who is going to get affected. So therefore, till there is a formal communication to the employee and till the terms and conditions are fixed, IFRS 2 will not be attracted. Okay. So the standard will be attracted only when there is a binding arrangement. So write down 2 lines in the notebook, in the book. Since there is no formal communication stating the terms or conditions, since there is no formal communication stating the terms or conditions of the agreement, it will not attract IFRS 2 provisions. It will not attract IFRS 2 provisions. The standard will be attracted. The standard will be attracted when there will be binding agreement. The standard will be attracted when there will be binding agreement. So when you are solving a question and if you are given a case study like this, then you will not start applying IFRS 2 immediately. You will start applying the standard only from the date a binding arrangement is entered into between employer, employee, employer or the entity and the other entities, other parties. Second is, share-based payment should be made for goods and services and should be with an external party. But that external party can include employee also because he is rendering the services. A share-based payment arrangement with shareholders are not considered. Okay, now first you answer this wonderful question number 2. A goods or service has been received by an entity for which it has issued its own shares to the counterparty who has supplied the goods at discount or premium. The value of the goods received has been paid by using its own shares. But if the fair value of the goods received are more or less than the value of the shares issued by the entity, then some unidentified goods or services will be received or have been received, which means the fair value of the share issued is more than the fair value of goods received. So the difference, they have termed it as unidentified goods or service received. Okay. Will this arrangement also be classified as share-based payment arrangement? Will IFRS 2 be applicable? So here the standard has clarified that sometimes at the time of transaction, there may be some unidentified goods or service which they will settle later. That will also be covered in IFRS 2. So write one line answer. IFRS 2 will still be applicable for such unidentified goods or services. Only for theory question this is there, but there is no problem in the material where there is a question on unidentified goods or service. Okay, now one more question for you. Those who have done question number 3. An entity issues its own share for a charity. Wow. Without any consideration. Will IFRS 2 be applicable? Yes. No. There is no consideration. Okay. So what entry will you pass? Donation account debit. So donation is a charity you are doing. You are getting the blessing of others. Okay. Something you have to do here. So you have to account for it at the fair value of the shares issued. So the entity will get covered under IFRS 2. You have to record the donation given at the fair value of the shares issued. That's it. Next, point number 3. Right now we are understanding whether IFRS 2 will be applicable or not. So there must be proper terms and conditions finalized and communicated. It is for goods and services to external party, and the goods and services that are being received should be from a supplier. Person receiving it can also be an employee of the entity, no problem. One party may make payment to your employee, so it will be treated as an employee consideration also. Goods or service received from a counterparty who act in the capacity of a shareholder will not be covered by IFRS 2. So if a shareholder makes payment, okay, in the form of goods and service, so instead of paying application money in cash, instead of paying allotment money in cash, or instead of becoming a when you invest in a company, instead of paying cash, you can give some form of consideration in the form of goods or service, and then you get shares as a shareholder. Will IFRS 2 be applicable? IFRS 2 will not be applicable. Okay. Now see one example there. For example, we don't have to write the answer. Service maintenance agreement has been entered by an entity with one of the supplier outside the entity. The agreement requires to pay for the services by issuing equity share of the entity. So the question they may ask you whether IFRS 2 will be applicable or not. Now prima facie your answer would be yes. Okay, such an arrangement will be covered under IFRS 2, but then you can also write a note if such services are provided by shareholder in his capacity as a shareholder. Shareholder in his capacity as a shareholder, then this will fall outside the scope of IFRS 2. That means in order to get the shares, he is providing the services. So consideration for share acquired he is paying as a service. Now next is a transaction with an employee. In his capacity as a holder of equity instrument of the entity is not a share-based payment transaction. Some employees are also the shareholder of the company, and then company issues him right share. So now this time he is getting equity share as a shareholder, not as an employee. Will it be covered by this standard? The answer is no. Okay, and the question also is based on that point only, that if right shares are issued to all the shareholders, which include employee of the company, will IFRS 2 be applicable? Right? Answer is no, because the employees are receiving shares not as employee but as a shareholder of the company. So since the employees, right, little fast, since the employees who have received such services, shares, who have received such shares are acting in the capacity of the shareholder, and not as employees. this transaction will not be covered under IFRS 2. This transaction will not be covered under IFRS 2. Any share given to shareholder, but in his capacity as a shareholder.
Suppose I am a shareholder of ABC Limited.
You are a shareholder of ABC Limited.
You,
you provided some services also.
ABC Limited. And in for that services, they are giving me the shares of the company again.
Okay.
So, will the second transaction be considered as considered under IFRS 2 or not?
Now, here the company is getting some services, but that payment will be made for rendering of the services. Then the standard will be covered. But suppose you are a shareholder, you are issued right share, and then you also pay in the form of goods or services. So then the transaction becomes in the form of capacity as a shareholder. For the right share that is being issued to you, you are paying as a shareholder. But when the company is receiving services and then the company is making payment for that services, so that person can be a shareholder. It's same example like an employee. An existing employee who is a shareholder gets ESOP, but then that is for the services that is rendering in his capacity as an employee. Example 1. Service maintenance arrangement by an entity with one of the supplier outside the entity. This agreement requires to pay for the services by issuing equity shares of the entity. So prima facie the answer would be yes. This arrangement will be under IFRS 2. But if such services are been provided by one of its existing shareholder in his capacity as a shareholder, write down, then this will fall outside the scope of this standard. Let us say company wants to issue right share. Consideration paid by the shareholder. Yeah, you should add this. Drafting of the answer is not appropriate. Usual institutes problem. Okay, can we continue to this point number 5 now? Point number 5. For receiving such goods or services by an entity, it needs to settle the transaction either by. Now this point number 5 you tick mark. This will also help us to identify whether this is a share-based payment transaction or not. It will settle the transaction either by issuing its own equity share, very simple, or by group entity share, which is called equity settled, by paying cash equivalent to value of such share. That means it may be linked to price of entity share, it may be linked to price of parent entity share, or parent entity may say it may be linked to price of share of subsidiary share, or a combination of the two, where the settlement option rests either with an entity or with the counterparty. So basically this is the scope of this standard. These three plans are called equity settled plan, cash settled plan, and the third one is called equity settled plan with cash alternative. Equity settled plan with cash alternative. So basically these three plans will be covering our 90% of this current chapter. Then next point number 6. Equity instrument means what? Equity means residual interest in the net asset and liability of the company, and it will include ordinary share. It will include any written call option or warrants over such ordinary share. In fact, it will include all such equity instrument which come under the definition of equity instrument under IS 32. Okay. So it is not always equity share. It can be any other equity instrument other than shares, like share warrant. Because share warrants also allow you to buy shares at a very lower price. Point number 7, share-based payment transaction may be settled by own share or group entity share, which means that a parent of the reporting entity might issue shares on behalf of subsidiary for providing goods or services to the subsidiary. Now, how to do accounting of this transaction we will cover in the last part. Okay, where the parent company issues shares to the employee of subsidiary. Such arrangements are made in the group company. The reason being, parent may be a listed company, reputed company. Its share prices are available in the public domain. The subsidiary may be a small subsidiary, and if you give such ESOP to the employee will say, I am better off with cash. You give me some monetary consideration. I don't know what is the price of your share. Your share is not listed. Then how to create motivation among the employee of subsidiaries? Give them shares of parent company. Okay. Are such transactions also covered? Yes. Solve this example. No, this is question 5. Is it question 5? A parent issues shares to employees of subsidiary. Subsidiary company issues share options to its employee based on equity price of the parent company. Will IFRS 2 be applicable? Just write one line. Both the plans will be covered under IFRS 2. Both the plans will be covered under IFRS 2. And point number next, question number 6. An entity issues certain benefits to employees by taking a reference of earnings of next year. Will IFRS 2 be applicable? Is the benefit related to share or share price? The answer is no. So therefore, if the benefit is not based on share price of the entity, this transaction will not be covered under IFRS 2. Then you have to apply the standard on employee benefit, not this standard. Since the benefit is not based on share price of the entity, this transaction will not be covered under IFRS 2. Employee benefit chapter will be applicable. Write down. It may be treated as employee benefit under IAS 19. It may be treated as employee benefit under IAS 19. Paragraph next below question 6. Vesting conditions. So slowly and slowly we are going to first understand the background. So we have learned what is share-based payment, when this chapter is applicable. Now one important term in this chapter is vesting condition. What is vesting condition? Condition which are required to be fulfilled in order to get such share-based payment. Mostly in case of employees, vesting conditions are imposed. For example, the most common, the employee will work continuously for 3 years, 4 years, 5 years, or the company's sales should exceed 1000 crore and then you are eligible to exercise your option and purchase the share, or profit should exceed 100 crore, market price of share should exceed 30 rupees, something like this. Market share should exceed 80%. So these are called vesting conditions. And if there are vesting conditions imposed, then the counterparty, the other party, can acquire the shares only after fulfillment of, fill in the blanks, vesting conditions. Like this in example 2 in your notes, the stock option has been granted by an employee, by an entity to its employee who will remain in service for next 4 years. So what is the vesting condition here? Continuous employment for 4 years. So therefore those who would leave before 4 years will not get the stock option. So the vesting condition is 4-year service. Next paragraph, what is covered within IFRS 2? Some repetition, but don't worry. What is covered in the scope of IFRS 2? Even if an entity is not able to identify all goods and services that are being received by settling the transaction, either by issuing its own equity or group entity, or by paying cash value equivalent to equity prices. That means, in short, if there are some unidentified goods or services, payment made is more than the fair value of goods and service received, then also it will be accounted under IFRS 2, but it was already covered. Then it covers settlement in equity or in cash or alternative settlement. That means there are 3 types of payment that the standard accept: payment in the form of equity share, payment in the form of cash but linked to the price of the share, or there is an option given to the counterparty that either you take share or cash, or there is an option with the entity that we will give you share or we will give you cash. So these plans are covered. Unidentified goods or services that are being received will be covered by this standard. Such share-based payment can be settled by another group entity or by using equity share of group entity. That is also covered. Subsidiary promises to employee, parent company issues the share, will be covered. Employee of a company working as a service provider receiving such share based payment will be covered under this standard, like for example stock option or warrant. This standard is also applicable for payment made for goods in the form of company's shares. Goods will include inventory, consumable, PPE, or any other non-financial items. Solve one question. An entity grants 10 shares to its employees who will remain in service for next 2 years. Will IFRS 2 be applicable? Oh, that was a very simple question. It is applicable if you give options to employees. Payment can be made in the form of shares, cash linked to share price, or an alternative is given to employees. So this will be covered within this standard as an equity settled share based payment. So what will be the nature of this share based payment? Equity settled share based payment, where the settlement is done in the form of equity share. Now read this carefully and then answer. An entity grants 1000 rupees, INR means Indian rupee, to each employee, which is based on its current equity price of the entity. So each employee will get 1000 rupees, a fixed sum of money, which is based on the current market price. Will IFRS 2 be applicable? Cash settlement. Then what is the meaning of based on current price of the share? Yes, you. Why not applicable? Current price is fixed and they're giving 1000 rupees. So from the right now only know you are going to pay him 1000 rupees. So it is as good as you pay him 1000 rupees only. So this is a cash incentive you are giving to him based on current market price, not on future price. Whether the market price goes up or comes down doesn't matter to him. So this will not be covered under IFRS 2. So this you treat it like a form of cash incentive and apply IS 19 for this. Because there is nothing much to be accounted here. Payment made, so your entry will be employee benefit expense account debit to bank account 1000. Why you need to apply this complicated standard for this simple transaction? No need to calculate fair value, intrinsic value of the share, of the option. So this will not be covered under IFRS 2. As the amount of INR 1000 is fixed now, as the amount of INR 1000 is fixed now, and it will be paid to the employees, even if the market price of the share goes up or down from the current level. Next question solve. Is it there in your book? An entity received services from a party who is acting in the capacity as a shareholder will not be covered under this standard. Write down who is acting in the capacity of a shareholder. However, an employee who received additional payment from the entity for providing services other than its normal employment, he will be covered by this standard. If an employee works extra hard, company gives him share, will this standard be covered? Will this transaction be covered by this standard? Yes. And next paragraph says an entity has agreed to provide bonus to its employee purely based on the share price of the entity. Will this transaction be covered? Will this transaction be covered? Bonus to employee is related to share price of the company. So right, the answer is yes. Since the benefit is with reference to the share price of the entity, it will be covered under IFRS 2. Now there is a long list of items which are not covered under IFRS 2. So first we need to check whether we are under IFRS 2 or not. Then same line they are repeating so many times. Transaction for providing goods or service in the capacity of a shareholder is not covered. Okay. Second is there is an example. Entity grants all holders of a particular class of its equity instrument right to acquire additional equity instrument at a price that is less than the fair value of those equity instrument. And an employee receives such a right because he or she is a holder of equity instrument of that particular class. Question is whether this right share issued to employee in his capacity as a shareholder of the company, will it be covered by the standard? The answer is the granting or exercise of that right is not subject to the requirement of this standard. And then you tick mark this paragraph, business combination. That will be discussed in detail in another standard. Entity shall not apply this standard to transaction in which the entity acquires goods as a part of net asset acquired in business combination as defined by IFRS 3 or contribution for joint venture as per IFRS 11. Okay. In some student will say in business combination also we acquire inventory of the acquiring company. Will we apply this standard? No. Then you apply IFRS 3. Similarly, in IFRS 11, joint arrangement, a joint venturer may contribute some goods or service towards joint arrangement. We'll come to that in IFRS 11. An entity has issued equity instrument in exchange for control of the acquiree. Which standard is applicable? Business combination. However, now underline this because the same paragraph will come again in IFRS 3 also. If the equity instrument are being issued to acquirees' employees in their capacity as employee, then it will be covered under this standard. So this will have a counter discussion in IFRS 3. Payment made for acquiring control, of course, not applicable. Payment made to employees in their capacity as an employee will be covered. Next example below that. An entity buys a business from an individual to whom equity shares are being issued. The individual will be working as an employee in the combined new entity. Now here there are two answers. Case 1. If the equity shares are issued for business purchase consideration, shares are issued as a part of consideration, will this share issued against business combination come under this standard or IFRS 3? IFRS 3. But if the equity instrument is being issued in the capacity of accepting employment in the new company, so that fellow individual is now willing to work as a director or CEO of this company. Normally this is happening nowadays. You start a company, it is taken over by some big company, and then they hire you also because you only know that business properly, and they give you ESOP also so that you have some motivation to join that company and you don't start your own company again. Then it is covered. Okay. Financial instrument issued to buy or sell non-financial item which can be settled in net will be outside the scope of the standard. Such transactions are derivative transactions and that will be covered by IFRS 9. Okay. Then contract to purchase and sale of goods and services which are entered for settling in net amount or kept it for speculation purpose will be covered under IFRS 9. So this is about which items are not covered. Understood? Some are covered under IFRS 3, some are covered under IFRS 9. After this long discussion on what is covered and not, now come to recognition part. An entity shall recognize the goods or service received or acquired in a share-based payment transaction when it obtains the goods or as the services are received. So this is the recognition principle. You will recognize the goods and services only after obtaining the goods or in case of services after the services are received. Now solve this question. Is it there in your note? An entity, question number 9 on the next page. Question number 9, check. An entity purchases some inventory from a supplier. Some paragraphs we will discuss a little later. An entity purchases inventory from supplier for which the entity will issue 100 shares as payment. The fair value of this share is 15,000. When will purchase be recognized? When will purchase be recognized? Already discussed. When it obtains the goods. So the answer is, write down a small line, one line answer. As soon as the inventory is being received by the entity, the transaction will be recorded. The transaction will be recorded by a debit to the inventory, and credit to equity and credit to equity with an amount of rupees 15,000. With an amount of rupees 15,000. Now you have to write one more note actually. Why 15,000? Because the standard normally says you have to acquire record at fair value of goods and service received. But when fair value of goods and services are not available, then we take the fair value of the shares issued. So write down one more line, small font. Transactions other than with employee, are recognized at fair value of goods received. Transaction other than with employee are recognized at fair value of goods received if this is not reliably measurable. Fair value of shares can be considered. Fair value of the shares can be considered. Fair value of the shares can be considered. Fair value of the shares can be considered. Now come to that paragraph above 8. Above paragraph 8, there are few more lines pending. What about the credit effect? You have received inventory, for example. Okay. You have received the services from employee. Where will the credit be given? Now one has to check whether it is an equity settled SBP or cash settled SBP. If it is equity settled SBP, the corresponding contra effect will be given in equity. Okay. Or if it is related to cash settled SBP, the corresponding effect will be given in liability. So this is the difference between equity settled and cash settled SBP. Come to paragraph 8. Recognition depends on vesting conditions. The recognition will depend on vesting condition, if any. In certain cases, there may not be any vesting conditions. So now if there is no vesting condition, you will recognize immediately. Okay. Expenses, etc. But if there are vesting conditions, then you will recognize the expense or the asset over the vesting period. So if there are certain conditions, normally for employees this will be applicable, that you serve 4 years of service and then you will be entitled to exercise your option. If the service conditions are either service related means number of years of service he has to complete, or performance related. The company's sales must exceed 1000 crore, profit must exceed 100 crore. Okay, market share of the company should be 30%, market price should be so much, which needs to be completed in order to be eligible for share-based payment. Okay. Then recognition will be based on, now here some estimation will get involved, will be based on the best estimate of the expected vesting value of such share-based payment. So sometime we will have to estimate how many options will be finally eligible. Sometime we have to estimate in how many years this whole vesting condition will be fulfilled. For example, if it is related to sales, you will become eligible if you cross the sale 1000 crore. What is the number of years I will take for accounting purpose? It will be based on best estimate. Then employees are given options to purchase the share subject to you complete 5 years of service. Now, how many employees will complete 5 years of service when we are doing accounting in the first, second, third and fourth year, it will be based on estimation. Now there is a question number 10 below. An entity has given 100 stock option to each of its 1000 employees. For those who will remain in service for next 4 years. The grant date was 1st January 20x1. So far we have not read the definition of grant date. For that timing, it means the date when employee agrees to terms and conditions. That is the date of entering into the contract, you can say. So this is the starting of the accounting, grant date. How will the transaction be recognized? Will you recognize the entire amount in the first year only? In the last year? Or you will amortize it over this vesting period? Because he is rendering services over this 4-year period. So we are getting the benefit of his service over 4-year period. So we will account for these services or the benefit of this service over 4-year period. Write down. The condition to remain in service. The condition to remain in service shows that the condition to remain in, this is a logic also of the standard. Why we are amortizing over vesting period? Because there is a condition that you render 4 years of service, we will give you so much benefit. The condition to remain in service shows that the stock option has been given. The stock option has been given for the services to be provided in the next 4 years. To be provided in the next 4 years. Hence, at the end of each year, the entity will estimate the expected employee who will remain in service and accordingly will recognize the cost over 4 years. Benefit is to be spread over 4-year period. That normally what happens in stock option, market price is 100 rupees, you pay 60 rupees. So 40 rupees benefit we are giving to you, but this is for rendering services over 4-year period. So this is the cost of 4-year period, not one. Now next is type of share-based payment. Again, repetition, 3 types. I'll read it quickly. Equity settled, cash settled, and share-based payment plan with cash alternative. In this share-based payment plan with cash alternative, there are 2 types again. One where the employer has the option or the entity has the option either to pay share or to pay cash. And second type where the counterparty, the other party, has a choice whether he wants share or whether he wants cash. And accordingly my accounting will change here. Now you come to para 10, equity settled share-based payment transaction. What are equity settled share-based payment transaction? Those SBPs which will be settled in the form of equity shares of the entity or group entity, okay, or equity instrument. Most popular instrument is ESOP, okay. So slowly we are now moving towards accounting. First question is, how are you going to account for this equity settled share-based payment transaction? the entity shall measure the goods or service received and the corresponding increase in equity directly at the fair value of the goods or service received. Now understand this, in case if you are going to receive goods or service, but other than employees, my first priority goes to fair value of goods or service received. My first priority goes to fair value of goods or service received. But if that is not reliably measurable, then the fair value of the equity instrument issued will be used. Then the fair value of the equity instrument will be issued. That is why there was a note in that inventory problem which you solved, that you valued that inventory at fair value of share issued 10,000 rupees, but with a note that in case if the fair value of goods and services cannot be measured reliably, then in that case fair value of the equity instrument granted will be issued. Is this example there in your note? Somewhere below? An entity agreed to issue 100 shares to a supplier for providing consultancy service. Which is that question number? Second point, 7, second point. For next 2 years. Now here we are receiving consultancy service and we are issuing 100 shares. So this is a share-based payment transaction against receipt of service. There is a similar contract in the market which has a value of rupees 20,000. If I pay cash, I may have to pay 20,000 rupees for this service. But I am settling in the form of shares of the company. So what is the accounting treatment? The similar value of the contract will be used as a fair value of transaction unless there is no reliable fair value available. But there is an important note for employees. Okay. Bullet point number 3. In case of a share-based payment transaction with employees, the standard says use fair value of equity granted in case of employees. Right. For other than employee, fair value of goods and service received, if that is not reliably measurable, fair value of the equity instrument issued. However, for employees, you don't have to take the fair value of the services received. You have to directly take fair value of the equity instrument granted to the employees. What is the reason they have offered here? It is practically not possible to identify the fair value of the services rendered by such employees. So finding fair value of services rendered may be very difficult because these are your employees. They work for you. You are a specialized entity. Whatever may be the logic they have said, it is difficult. My question now is example 7. Point number 1. An entity has agreed to issue 100 shares to each of its 500 employees if they remain in service for next 3 years. Next 3 years being a service period for which these shares will be issued. Now the question is, how will you account for it? Will you take the fair value of services or will you take the fair value of equity instrument? Check whether the transaction is with employee or others. Employee. So the answer is fair value of the equity instrument will be used for calculating transaction value of the share-based payment. First we'll solve a small example. Question number 11. Right. And then we will further discuss. ABC Limited granted to its employees share options with a fair value of rupees 5 lakh on 1st April 20x0 if they remain in the organization up to 31st March 20x3. How many years they have to remain in the service? 3 years. On 31st March 20x1, ABC Limited expects only 91% of the employees to remain in the employment. On 31st March 2002, entity expects only 89% of the employees to remain in the employment. However, only 82% of the employees remained in the organization at the end of March 20x3 and all of them exercised their options. Pass the journal entries. Take out your notebook. Pass journal entries. But first, what you'll have to do, you'll have to do one complex calculation. What is that complex calculation? You have to find out how much expenditure I am going to recognize over each of these 3 years first. Is it right? What is the fair value of your this share option? 5 lakh. But then you will not account 5 lakh divided by 3. You have to calculate how much will be the value of the options vested, and that will require how many employees will complete the desired 3 years of services. At the end of year 1, 91% were expected. But then every year my expectations are getting revised. So my total expenses will get revised every year. So this is a very basic question, and the same logic and fundamental we will use for other problems also. So it will be better if you first draw a small step 1, which we will call expense to be recognized. Write down expense to be recognized. Write the name of chapter. Start on a new page. Start on a new page. Year 1, 2, 3. First write down number of years, vesting period 333. Number of years, vesting period 333. Fair value. Fair value 5 lakh given. In FR or IFRS paper, this fair value will be given to you. Don't worry. Calculation of fair value is not in the scope of this syllabus. Then write down expected to vest. First year they have said management expect 91%. 91% of the employees will remain till the end of year 3, which means the value of options is 4,55,000. So this is my expected expense over 3 year period. But when I go to next year, my expectations change. Now it is 5 lakh into 89%. Calculate 4,45,000. And when I go to the last year, it is 5 lakh into 82%. 5 lakh into 82%. Come on. 4,10,000. Now these are total expenditure to be recognized over 3 year period. This is my estimation of total expense at the end of year 1. This is my estimation of total expense at the end of year 2. This is my estimation of total expense at the end of year 3. Now the question is how to recognize. So every year we will calculate cumulative expense to be recognized based on the revised data minus any expenditure if I have already recognized, we'll deduct that figure. So first write down cumulative expense to be recognized. Total is 4,55,000. This is the first year. So take 1/3 of this number. 151,667. Total 2 years are over. So by this time I should recognize 2/3 of the total expense. Take 2/3 of this number. 296,667 and then recognize 4,10,000 fully. But this is cumulative. Cumulative means up to year 1. Year 1 and year 2. Year 1, 2 and 3. Correct? I have to recognize individual year the expense relating to that year. So now I will write point E, expense recognized up to last year. Expense recognized up to last year. First column always 0. What about second column? 151,667. Third column 296,667. And therefore expense to be recognized in current year. First year same figure. The difference between cumulative and up to last year is the current year expense 1,45,000, and the last year again take the difference 113,333. Okay, any other format you can prepare if you can give me the same three figures. Okay, if you can find some simpler presentation which will take less time, do that. Now write down journal entries. Question is past journal entries. First, second and third year, these entries will be repeated, only the amount will change. So write down 31st March 20x1, employee benefit expense account debit. Is it employee? Yes. Employee benefit expense account debit 151,667. Keep the last line in front of you for numbers. To share based payment reserve equity account. Now this credit will given to equity account because this account will ultimately get converted into issue of shares. And even if it is not converted into equity share, it will be transferred to any other equity account. So what is the end product of this account? Either it will get converted into equity share capital or it will get transferred to any other reserve. There is no obligation to pay cash share. So it's an equity account. Then write down 31st March 20 x1, one more entry. If nothing is given, assume it is charged to P&L account. P&L account debit to employee benefit expense account. Second entry. Transfer to P&L account related expense. Okay, understood? Repeat it again, keep one line blank. Change the date, change the amount. Entry will be same. Write down 31st March 2000 x2. Employee benefit expense account debit 1,45,000 to share based payment reserve equity account 1,45,000. You can give any other name also to this share based payment reserve. Is it 1,45,000? Now write down 31st March 20x2 P&L account debit to employee benefit expense account 1,45,000. Repeat one more time. 31st March 20x3 employee benefit expense account debit 1,13,333 to share based payment reserve equity 1,13,333. P&L account debit to employee benefit expense account 1,13,333. Now 3 years are over and we have to issue shares. Is there any lapse? No. All employees exercise their option. Dear student, tell me the entry for issue of shares. So I will debit share based payment reserve account and I will credit the equity share capital account. Because They have not mentioned the number of shares issued. So I can't write share premium account separately. Okay, this answer is over. Now we'll continue tomorrow.